Hello, my name is Jimmy Sexton. I'm the president of Esquire Group, and we're here to discuss the exciting topic of the tax obligations of American citizens and residents abroad. This is going to be a four-part series. We're going to start off by discussing who this applies to and the income tax obligations. Then we're going to move on in part two and discuss the FBAR, the Foreign Bank Account Report. In part three, we're going to talk about estate and gift taxes. And then finally, in part four, we're going to be discussing how to get into compliance in the event that you've not been complying with these laws. So the first thing is to determine who these laws apply to. So obviously, if you're a U.S. citizen, if you're an American citizen, these laws are going to apply to you. But these laws are also going to apply to you if you're considered a U.S. resident. A U.S. resident can be somebody with a green card. They're always going to be considered a U.S. tax resident. And also people with visas, or even people who are illegally in the United States if they've spent enough time in the U.S. So you can accidentally become a U.S. resident simply by spending too much time in the United States. This is called the substantial presence test. The substantial presence test basically says if you spent 183 days in the U.S. over the last 3 years, you're considered a U.S. resident. But it's not as simple as just adding up all the days in the last 3 years. The IRS just couldn't make it that easy on us. We're going to start off now by talking about the income tax. Now, if you're a U.S. resident or citizen, you're liable to the U.S. For tax on your worldwide income. That means even if you don't live in the United States, you still have to file a tax return and pay tax in the United States. Now, there's some special considerations that may help alleviate double taxation, such as the foreign earned income exclusion, the foreign housing exclusion or deduction, the foreign tax credit, and then there's also certain disclosure requirements that you have to meet for foreign accounts and entities and things of that nature. So we're going to move right along and start talking about the foreign earned income exclusion. The foreign earned income exclusion is very, very important for U.S. citizens and residents living abroad. Basically, this allows you to earn a certain amount of money tax-free every year. Now, the amount is adjusted yearly for inflation. In 2014, you can earn $99,200 tax-free. Now, one of the important things to keep in mind is that it's called the foreign earned income exclusion, meaning that, that it has to be earned income in order to apply for this exclusion. If it's passive income, such as interest or dividends, capital gains, this is not considered earned income, and you'd be taxed on those subject to the foreign tax credit. The foreign earned income exclusion, again, is for earned income like wages, commission, self-employment income, basically income that you've generated through your efforts of working. One of the key things to remember about earned income is that the U.S. determines the source of income based on where the service is performed. For example, you could be living in Germany but working for an American company and being paid by an American company. This income would still qualify for the foreign earned income exclusion as long as you were considered a resident of Germany. And we're going to speak about residency a little bit later. You're also entitled to the foreign housing exclusion. The foreign housing exclusion is over and above the foreign earned income exclusion and is meant to help mitigate the costs of housing overseas. Now, the foreign housing exclusion or deduction is equal to 30% of the maximum foreign earned income exclusion during the year. So for 2014, the maximum foreign housing exclusion or deduction you would be entitled to is $29,760. Another thing to keep in mind with the foreign housing exclusion is that the maximum may not always be attainable based on the calculation. Also, if you live in a high cost location such as Vienna, Austria, or London, England, or Tokyo, Japan, there's higher limits over and above the standard foreign earned income housing exclusion or deduction. Some of the items that can be counted towards the foreign housing exclusion or deduction are things like rent, insurance, utilities. So it's really important to make sure, if you're an American citizen or resident living abroad, to keep track of those expenses. Now, in order to qualify for either the foreign earned income exclusion or the foreign housing exclusion, you have to be considered a foreign resident. Now, there's two ways to be considered a foreign resident. One is by meeting the physical presence test, and the other is by meeting the bona fide residence test. Now, the physical presence test requires that you be present in a foreign country for 330 days in a 12-month period. Now remember, the 12-month period does not necessarily have to be a calendar year. It just has to be 12 consecutive months, so it could run from April to April, for example. It's also important to remember that when counting these 330 days, they have to be present in a foreign country. So, for example, if you're on a family vacation on a cruise, you're in international waters. That's not considered being present in a foreign country. You cannot count those days towards your 330 days. Likewise, any part of a day spent in the United States is not going to be considered a foreign day. So it's very important that you pay close attention to what days are actually counted as foreign days to make sure that you're able to get your 330 days if you're qualifying under the physical presence test. Now, the second test is called the bona fide residence test. This is a more lenient test that is not as stringent with how many days you have to spend in a foreign country. But in order to be considered a bona fide resident of a foreign country, you have to have been a resident of that foreign country for an entire calendar year. That makes it difficult to qualify for the bona fide residence test in the first year that you move out of the United States. So in most cases, a taxpayer, U.S. citizen or resident who's living abroad is going to qualify in year one under the physical presence test, and then in year two would be able to meet the bona fide residence test. Now, the nice thing about the bona fide residence test, like I said before, is it's a little bit more lenient with the days that you're present in a foreign country. So it allows you more time in the United States, and it allows you a lot more luxury in terms of your travel not being present in a foreign country. Now, another mechanism in the U.S. tax code that helps alleviate double taxation is the foreign tax credit. And basically what the foreign tax credit is the U.S. allows a credit against U.S. tax for foreign income taxes paid. So for example, let's say your foreign income tax rate where you live is 40%, and your equivalent rate in the United States would be 30%. Since you paid a higher tax rate in a foreign country than you would pay in the United States, your tax in the U.S. would be wiped out. There's special rules for calculating the foreign tax credit. For example, any income earned in the United States is not subject to the foreign tax credit. Another thing to keep in mind, and this holds true for the foreign tax credit as well as the foreign earned income exclusion and the foreign housing exclusion, and that is they don't apply to self-employment tax because self-employment tax is not considered an income tax. So even if you were a self-employed individual and your entire income tax liability was wiped out in the United States by virtue of the foreign tax credit or the foreign earned income exclusion and housing exclusion or deduction, you may still owe self-employment tax in the United States. Now, if the U.S. has a Social Security agreement with the foreign country in which you reside, and you're paying into that foreign country's Social Security system and can provide what's called a certificate of coverage to the United States, that you're being covered by their Social Security system, then you would be alleviated of paying Social Security tax in the United States. Now, one of the other things that's different about the U.S. tax code than the tax codes of many foreign countries is that the U.S. requires you to report certain types of foreign accounts and assets. One of those things is on your 1040 on Schedule B, there's a question that asks whether or not you have signature authority over or a financial interest in a foreign financial account. Foreign financial accounts can include a lot of things that are fairly self-explanatory, like a bank account or a brokerage account. But they can also include things that you may not think of, like a life insurance policy, an annuity, a private retirement account, or even a security deposit on a rental property. Furthermore, you must disclose whether or not you've received a distribution from a foreign trust, whether you're the grantor of a foreign trust or you transferred assets to a foreign trust. Again, these questions are on Schedule B of your Form 1040. In addition to reporting foreign accounts on your 1040, you could be required to file additional forms disclosing ownership of various foreign entities. If you're a shareholder in a foreign corporation, it's quite possible that you'll have a filing requirement to disclose your ownership of that foreign corporation. Likewise, with foreign partnerships, you would have to disclose your ownership in certain foreign partnerships, foreign disregarded entities, and also in foreign trusts. And here's a term that many of you probably have never heard: a passive foreign investment company, or a PFIC. This is normally a foreign mutual fund. There's yet another form that you have to file if you own foreign mutual funds. Failure to file any of these forms can be really expensive. The IRS is not forgiving. As many of you know, the U.S. is broke, and the IRS, being their collection arm, is on a rampage to get as much of your money as they can. So the penalty for failing to file most of these forms can be $10,000 per filing per month. Additionally, if you fail to file any of these forms, there's an unlimited statute of limitations. That means that the IRS could come back and audit your tax return and assess penalties and interest 20 years from now. And if you don't think they'll do that, think again, because their technology is getting better and better to detect shortcomings in tax filings. You don't want to get a surprise 20 years down the road. And of course, the worst part is you could be criminally charged in the event that you failed to file any of these forms. Now, the newest part of the income tax reporting responsibilities of Americans and residents living abroad is something I'm sure many of you have heard of. It's called FATCA. It's the Foreign Account Tax Compliance Act. This became law on March 18th, 2010, and was intended to help catch Americans cheating on their taxes, evading taxes, and hiding money offshore. Now, the unforeseen consequences of this are that normal U.S. citizens and residents living abroad are getting caught up in this net and having a hard time opening bank accounts and complying with the U.S. tax laws. But basically what FATCA does is it adds a new form that has to be attached to your tax return to report what they call foreign financial assets. Foreign financial assets are bank accounts, brokerage accounts, certain insurance policies, annuities, financial assets of that nature, as well as stocks and securities of foreign entities. Can also include a financial instrument or contract with a foreign issuer or counterpart. That's normally going to be an insurance policy, an annuity, or something of that nature. In order to comply with FATCA, you have to file Form 8938 with your tax return. If you're a U.S. resident, that means a U.S. citizen or resident living in the United States, and you're single, you're required to do the FATCA reporting if your foreign financial assets exceeded $50,000 at the end of the year or $75,000 at any point during the year. If you're married and you file a joint return and reside in the United States, then those numbers are doubled. Those thresholds increase to $100,000 at year end or $150,000 at any time during the year that would trigger the necessity to file the FATCA forms. Now, if you're a foreign resident, those numbers increase. It's a higher threshold because it's more likely that you're going to have foreign assets that would need to be disclosed. So if you're single and you're a foreign resident, you would be required to file the FATCA forms if at year end the value of your foreign financial assets is $200,000 or more, or if they exceeded $300,000 at any time during the year. If you're married, filing a joint tax return and residing abroad, those thresholds increase to $400,000 at year end or $600,000 at any time during the year. In order to be considered a foreign resident for FATCA purposes, it's much like the foreign earned income exclusion or foreign housing exclusion deduction in that you must meet one of the two tests, either the physical presence test or the bona fide residence test to be considered a foreign resident. There's also special rules for allocating assets between husband and wife. It's best to consult a professional to determine how those assets need to be allocated. Likewise, there's special rules for when appraisals are required, for which exchange rate to use when converting this to United States dollars. All of those things are complex and often necessitate the need for a professional. Now, failing to comply with FATCA can be expensive and painstaking. So again, like the failure to report the other forms that we discussed, the ones that report foreign corporations and partnerships and so forth, the failure to file your FATCA forms could result in a $10,000 penalty for failure to file. That penalty can go up to $50,000 if the failure continues after the IRS has notified you. Again, there's an unlimited statute of limitations, and a lot of people ask, well, how am I going to get caught? Well, the foreign banks are telling on you. Most foreign banks are now becoming what's called FATCA compliant, and they're starting to turn over the names of U.S. taxpayers to the IRS. If your name's on that list and your returns are not reporting those, you can bet you're probably going to get a call from the IRS. Well, that concludes part one of this segment. We'll be talking about the FBAR, Foreign Bank Account Report, in part two. See you in the next part.